Hi guys, so let's now get into this big concept regarding comparative advantage. It's an absolute crackerjack this, so let's get going. Right, first up we can see we've got absolute advantage. Now absolute advantage just refers to where one country has numerical superiority or can produce more of a given good than another. Let's just check out what I've drawn out in this little matrix here. We've got Portugal, we've got the UK, we've got cloth, we've got wine. Well, we can see that the UK can produce more cloth than Portugal, so therefore the UK has an absolute advantage. Meanwhile, Portugal can actually produce more wine than the UK can. So Portugal's absolute advantage is in wine there, okay? So we can see that quite clearly. Now, comparative advantage is really the big one here. This is David Ricardo's theory, which is over 200 years old now. So let's have a look at this, where one country can produce at a lower opportunity cost ratio than another. So now, unlike numerical superiority, we're now considering opportunity cost ratios. So let's just work through our opportunity cost ratios here. Well, let's have a look at wine. Now, Portugal can produce 1 unit of wine, okay, and we can illustrate this nicely with a PPC, with cloth on our y-axis and wine on our x-axis there. So they can either make a choice between producing 10 units of cloth or 5 units of wine there, okay? Now, the ratio that actually exists here is 5 to 10, okay? So it's therefore a 1 to 2 ratio. So if they were to drop their production of wine down to 4 units, then they would boost their production of cloth to 2 units, okay? Now, meanwhile, when it comes to the UK, well, we can see the ratio is very different. So the ratio is 1 to 12.5, all right? You divide 25 by 2, of course, it's 12.5, so it's 1 to 12.5. All right, so therefore, we can see that based upon this, coming back to this definition, where one country can produce at a lower opportunity cost than another, well, we can see the lower opportunity cost lies with Portugal in the production of wine, okay? So that clearly identifies the fact that if these countries actually want to engage in meaningful trade, they'd be best off with Portugal producing the wine. Now, if we then just have a look at the cloth over the other side, well, we can then see that, well, 10, how many times does that go through? Well, of course, 1 to a half, basically, isn't it? Okay, so it's 1 to a half. Now, 25, well, okay, let's just have a look at this. Now, we've got 1 now to 0.08 or so. Okay, and that is literally this 1 unit divided by 12.5, okay? So we get 0.08. This tells us that the comparative advantage in producing cloth clearly lies with the UK. So that's nice and straightforward. Let's just illustrate the UK's PPC, production possibility curve here. So we're going from 25 down to 2. Okay, now these are really useful to have a look at. These will help you to understand it, and it could be that you get a multiple choice question which is laid out much like these two PPCs here. Now you can see that the steeper curve lies with the UK. That tells us quite simply that the comparative advantage lies with the UK when it comes to producing cloth, but for production of wine, we can see that Portugal's is flatter, therefore they have the comparative advantage in producing wine. Okay, so of course they can determine, these countries, as to where they want to actually produce. Now, if they work individually, independently, they may choose to actually balance their production at a level round about here, which would equate to something like 7.1 and perhaps 1.4 units of wine, okay? So both of them can actually achieve that ratio at point A. We can see that it's just on the edge of both of their boundaries, and that's what they could conceivably achieve between themselves. So Portugal could produce 7.1 units of cloth and 1.4 units of wine, all right? And likewise the UK. Now, that's interesting, but what's really, really interesting is whether we actually consider these countries wanting to actually trade. And if they choose to do so, just notice what can actually happen. The UK could focus on producing 25 units of cloth, because that's where their comparative advantage, their lowest opportunity cost ratio lies. So they can do that. Meanwhile, Portugal, of course, would then focus on producing 5 units of wine. And then both of these countries could engage in trade, which effectively shifts out the PPC for both of these countries. So instead of point A now, what is actually attainable for both of these countries to get by on is a ratio of 12.5 down to 2.5, okay? So we've now actually increased welfare. Economic welfare has greatly increased because both of these countries' PPCs have shifted out effectively and can now reach a point beyond their original boundary that they couldn't do without trading. So this is really why comparative advantage is so important. If a country specialises in what it can do at its lowest opportunity cost, then it is mutually advantageous to engage in trade. All right, so that's nice and straightforward, I hope. Now, just notice throughout this, we have had some very, very simple assumptions utilised throughout this theory. And these assumptions really do form an excellent means of actually evaluating the relevance of Ricardo's theory of comparative advantage. So we can see in this model, we've got just 2 countries. Well, how realistic is this? Of course, in today's globalised world, it's not so realistic. We've got just 2 goods. And we're not considering the quality of those, we're considering that they're producing equally good quality goods as one another. Again, that seems a little far-fetched. The PPCs that we've illustrated, well, they're straight line PPCs, and as they're straight lines, it really reflects that there's perfect factor mobility. So if you remove workers and machinery from producing cloth, they can easily go into the production of wine. Well, how easily does that truly happen? Typically, these PPCs bow outwards, and why do they do that? Well, it's because some resources are better used in the production of, say, butter, rather than producing perhaps guns. Okay, that's a typical example with PPCs. So there's also this constant returns to scale that we can see here, okay? So that is, if there were more resources actually put in here, then we could expect these PPCs just to kind of shift outwards accordingly, all right? That there's no impediments to trade, so there's no transportation costs, there's no political factors which are considered which may influence trade, such as free trade areas, and that there are no tariffs or protectionisms, there are no impediments to trade. And finally, there are no externalities included within Ricardo's model. So while it does suggest that international trade is entirely advantageous, perhaps given these assumptions, it is a little bit far-fetched. We'll move on to look at some of the analytical and evaluative points in our next lesson. Guys, that's it there. I hope that's been all right. See you next time.